Hey TMFG community, today's video is on strategies you can utilize during market downturns. Remember, if you do enjoy the content, like, comment, and subscribe to the YouTube channel. We love doing these videos for you. In today's episode of Ask TMFG, we're going to be discussing the strategies you can utilize right now during the market downturns to best maximize your portfolio. So I'm going to hand it over to Carlo Cancino and he can get us started. Carlo?
Thanks, John. Now, for many of you, this is going to be a refresher, but it's in times like this that we need to have this reminder of what we should be doing in a very volatile market. So, number one, simple enough, stay invested. Now, I know you've heard it before, but this is the best thing you can do when the market is dropping. Simply put, you still own the same number of units or same number of shares as you did before the drop. It's just the value of those shares or units have dropped in value. The moment that you sell those shares or get out of the market, you realize those losses and you don't have the opportunity for your units to grow back up in value when the market recovers. So do yourself a favor for the long term. Don't try to time the market, just stay invested. Number two, look for alternative income sources. So if you are using your portfolio as an income source, in a very steep down market, it might make sense to look for alternative income sources. So whether that's an emergency fund that you've set aside for moments like this, 6 months, 12 months worth of cash or expenses that you can use and limit the withdrawals from a dropping portfolio. That, or if you don't have an emergency fund, you can use a low interest credit facility like a home equity line of credit. Borrow from it temporarily until your portfolio recovers. You can take the money out at a later date to pay off that line of credit. Number three, rebalance. Again, you've heard this many times in our meetings. We need to rebalance the portfolio when its asset allocation has deviated from its target. So when we look at a portfolio, you have a target asset allocation. It might be 70% stock market exposure and 30% bond exposure. Given that the markets are dynamic and we see a drop in the stock market, your portfolio might make up stocks may only make up 60% of your portfolio after the market drop, and the bonds make up 40% of your portfolio. It's at that time that we would rebalance, sell 10% of the bonds to bring it back to 30% of the portfolio, reinvest those proceeds in the equity position. Now you're back in a position where when the market does recover, you have more units of the stock market portion of your portfolio because you purchased them at a discount. So when the market is moving, rebalance your portfolio back to its target mix. And lastly, number four, if you have cash or money to invest, do it. Don't wait until you see the portfolio or the market recovering. Now is the best time to get your money working the hardest for you. Sitting in cash on the sidelines, you already know about what inflation's doing to purchasing power. It's eroding all of the purchasing power of your cash. Food, gasoline, to name a couple, are up almost 50% over the year. Money sitting in a bank account isn't coming close to that. So that money needs to be invested. Take that money, get it into your balanced portfolio. Even if the market drops, 10 years from now, if you have that length of time, where we are now is going to be a low point. So the longer you wait to get your money into the market and given the potential for it to grow, the longer your money will lose purchasing power. So those are the four strategies, as a reminder, that you can implement in a down market.
That's great, Carlo. And I guess the one word to kind of wrap it all together is just staying disciplined, right? Where we have difficulties in the market, that's where people tend to make mistakes because they get that emotional reaction. They want to sell out of the market. They want to deviate from their plan because things aren't going the way they expected they would. We try to get it into the heads of our clients, expect market downturns. They are just a regular part of the process, but like every other market downturn in the past, this too shall pass. And then we'll be on to greener pastures and earning those returns that you're expecting. So excellent points there, Carlo. Just want to remind you guys, if you do enjoy the content, like, comment, and subscribe to the YouTube channel. But until next time, I'm John Iaconetti,
I'm Carlo Cancino.
and this has been Ask TMFG.